Thank you so much for joining. Where are you coming in from today?
Great to be with you, Brendan. I'm here in sunny Manhattan, which isn't sunny, but I wish it were.
Nice. Would you mind just kind of starting with your role at Goldman Sachs and how Goldman as a company across all of its various businesses just thinks and approaches sustainability?
Yeah, sure. I'm a partner of the firm, and I work within Goldman Sachs Asset Management, where I lead our ESG and client strategy efforts. I also co-chair our division's Sustainability Council, which is composed of our senior investors and business leaders from around the world. And just to orient the audience, GSAM manages about $1.4 trillion of client assets on behalf of institutions and individuals from all over. On your question around sustainability, as a firm, we believe, first as a definitional matter, sustainability involves activities that advance the pace and effectiveness of the climate transition that we need and accelerate inclusive economic growth. We've committed to help deploy $750 billion of capital across our financing, investing, and advisory activities by 2030 to advance sustainability. And within our asset management business, our goal is to provide our clients with robust investment solutions across asset classes. And an important part of doing this is considering the role of ESG in those portfolios. So in short, we see sustainability as an increasingly important focal point for capital flows and asset management.
And, as you think about kind of when we're recording this, right, where COVID-19 and its aftermath is so imminent, it's so proximate to our experience. When you think about COVID-19 and how investors and capital markets have responded, and then you think about the climate crisis, in some ways they are parallel issues insofar as they're both collective action problems, right? We all need to act cooperatively. What do you think can be learned from capital allocators' response to both issues for one another?
Well, it's a very good question, and there's many complex issues embedded in it. Let me take the vantage point as a capital allocator. So one issue that question raises is that of cause and effect. So you mentioned collective action. What's a cause and what's a response to an effect? And I think it's fair to say that most allocators of capital have the obligation to try to mitigate risks that could diminish the value of any investment that they make. Now, to the extent that climate change could adversely affect an investment, that clearly needs to be considered. But what I would say is increasingly capital allocators are focused on the positive externalities that their investments generate. And in this sense, the degree to which an investment can drive change, so that's the cause, is increasingly at the forefront. Give you an example. At the corporate level, you see this quite visibly in the net zero emissions targets set by many companies for their operations. In many cases, these companies have concluded it's in their interest to reduce the climate impact of their operations without being required to do so. They want to be part of the cause. In this sense, some of the CapEx or investment spend that they're going to deploy will advance sustainability. And in turn, portfolio investors who provide capital to those companies are supporting this. Now, what's really interesting to note is that there can be a positively reinforcing circle, or at least that's the goal. So to the extent companies generate greater investor interest, at least in part, because of their sustainability initiatives, they may enjoy a lower cost of capital, which may in turn have beneficial effects on their ability of those businesses to invest and grow. In this way, many companies see leading with sustainability, even if it involves a great deal of effort or initial capital and managing uncertainty, they are trying to find themselves in this self-reinforcing circle. So in this way, both companies and the allocators of capital have a role to play in promoting sustainable choices. To give you a sense of the data, the capital flows, if you look at a number of the databases that track asset flows into commingled funds, so I'm speaking of mutual funds and ETFs around the world. Year to date through July, the flows of assets into strategies that had sustainability as integrated and core to their activity was something like a positive $150 billion.
Wow.
The assets that, or strategies that didn't, were in outflow. And they were an outflow double to the inflows of those sustainability strategies. Now, short period of time, but what's interesting there is a capital flow, and maybe some of this self-reinforcing cycle is emerging.
Yeah, and for what it's worth, obviously we see that same dynamic in the real estate industry, in the sense that real estate is, if anything, a cost of capital driven business. And some of the largest capital allocators on earth have come out and said, we will favorably deploy capital towards low or no carbon impact real estate owners. And I think the world is now creeping up on how to measure that and how to audit that. And so to the extent that becomes self-reinforcing, it's like they have a lower cost of capital. They're able to provide space at a lower cost to tenants. Tenants care about it more. All those things can kind of affect that same virtuous cycle, but within the real estate ecosystem.
Interesting. Yeah, for sure. Great.
And I'm curious, when you look at the US and you look at how civic authorities and how corporations have approached sustainability, what have you seen as kind of the best approaches? And I'm curious, as a related question, what do you think the rest of the world can learn from the US, which is kind of a counterintuitive point on this, that there's actually a lot that the world can learn from how the US has approached this?
Yeah, well, let me zoom out and I'll answer that. But let's look at kind of around the world what's happened just this year alone. Obviously, there's been lots of fiscal spending from government authorities given the economic effects of the crisis, and we've seen a lot of that stimulus spending by governments pegged to sustainability. I'll give you some examples. About a third of South Korea's stimulus spending this year was devoted to efforts focused on climate mitigation, things like electrified transport, energy efficiency, and the like. The European Union's collective stimulus earmarked over about $70 billion for a range of green projects. China recently announced it's targeting peak carbon dioxide emissions, CO2 emissions, by 2030 and carbon neutrality by 2060. That was a recent statement. Now, closer to home, California last week said it would ban new combustion engine vehicles starting in 2035. And so I think what you have around the world is sort of a dialogue among policy initiatives at the national and subnational level, where there's a range of experimentation but the direction of travel is clear. I would say the California announcement is interesting because there's lots of subsidiary actions that have to take place to make that realistic. So there are certain things around the electricity grid example that have to get developed. But these audacious goals or these bold goals, I think, are important for pointing the direction of where capital needs to go. Now, in terms of the U.S. leadership, you've got certain things from subnational actors, but you also have the private sector. An awful lot of the transition we've been talking about has a technological component to it. Think of many U.S. companies who are at the forefront of innovation. There's battery technology and storage. There's alternative fuels. There's digitization of some services that can reduce carbon output. So many of these policy steps and their technological breakthroughs will take years, and there's sort of a relationship between both governments and private sector actors. So in terms of US and the world, I would look at it as around the world, you've got governments and private sector actors all trying to innovate and move forward.
Yeah, and again, there is a parallel bringing that down to the real estate industry that, I think technology is advancing at a certain rate. And I think a lot of real estate owners will say, we want to adopt more sustainability forward technology, both because it's economic, it's an economic decision for them, but also because of the altruistic side of it. And they're just hoping that technology can accelerate to that level where cost effectively you can deploy it and can actually reduce your carbon footprint. We're just not quite there yet. And to some extent, so much of this conference is exploring, how do we get there, right? How do we encourage private sector activity, private sector investment into the very technologies that will help certain industries decarbonize? Just from your seat, the seat you sit in, which is obviously one of the most prestigious, influential capital allocators and financial institutions on earth, I guess, what do you think are the biggest opportunities from a corporate perspective to address climate change, and who do you see out there doing it best?
Well, I think in the vein of the comments that you made about what the real estate industry faces, I think the biggest single opportunity is for each business to link the relationship of the products and services that it produces or generates to developing a plan to position itself for a low carbon world, coming back to cause and effect. So Clearly, businesses have to adapt to the climate that we're facing now. There's a lot of carbon that's been emitted over the past century and a half. And so clearly climate change is upon us. You have to adapt your business to that. You're going to have to take steps to adapt to the world that we're seeing, which could be very, very different than the one that we're in. That's the biggest single strategic thing I think companies can do. Now, the specific manifestation of that will vary by industry and by size of business. You know, a couple bits of innovation. I mean, you've seen some of the large US retailers partner with stakeholders, which includes customers and supply chain partners, to lower their carbon footprint. So it's not just the business itself, but it's all the ecosystem that supports it around it. How are they marching together to a lower carbon vision? We've seen a number of large companies make those announcements and pledges. You've seen a lot of climate tech investments, sometimes at the frontier. Sometimes that comes from portfolio investors and venture capitalists, but sometimes it comes from operating businesses too, that'll have corporate VC that they think is important to stimulate the technological developments that we need. And then we have things like, I guess it's not a very nice, good word, but it's co-opetition, really. So you see competitors who are partnering together to address a common bottleneck. An easy one to think about is packaging. Lots of retail competitors compete with each other, obviously, but they all need packaging that has a much lighter environmental footprint. There's a number of initiatives where would-be competitors have formed alliances to develop that packaging. And so I think across other businesses, you'll see key inputs where competitors will combine, you know, their efforts to improve that. So I think the opportunities are pretty wide.
And it's interesting because real estate has this unique characteristic, right, of it is so locationally driven, obviously, as an industry. And they have the assets have such long life cycles, meaning you have to worry about both functional obsolescence from a use standpoint or a demand standpoint, but now you have to worry about it also from an environmental standpoint. And you have to consider, obviously, the materials that you are pouring into the ground, or you know, the glass envelopes you're installing, because those are expensive transitions to make, but we have to kind of build that modularity. I guess, what role do you see developers and allocators to the real estate industry? What role do they have in just ensuring that our buildings are sustainable and durable from an environmental perspective? And not just with respect to climate resilience, just with respect to meeting the ever-growing demand and ever-growing standards around sustainability?
Well, I think, you know, one way to answer that question, and I wouldn't, you know, there are many in the audience that are far more expert at real estate than I am to approach that, but I would look at the financing markets kind of as a guide. So one area of innovation that may be relevant to your question is what we call sustainable finance. You see it in the corporate world, where increasing amounts of sustainability linked bonds are being issued. So they're tying their capital needs to climate goals. In the last couple of months alone, we've seen some very large issuances of these bonds. And the way these bonds generally work is the coupon payment varies based on whether the corporate met certain sustainability goals. If they meet them, they pay less in interest. If they don't meet them, there's a punitive aspect to it. What's actually extraordinary and an important signal, the European Central Bank recently announced that sustainability-linked bonds would be acceptable collateral and are eligible for their asset purchase programs. Generally speaking, bonds that have variable coupons are not, but they made the exception for sustainability-linked bonds, which I think is a pretty powerful signal.
And again, speak to that virtuous cycle, right? If the government is now buying these financial instruments, drives down the cost of capital.
Absolutely. And so the question, I think, around the projects that you're talking about, these are longer dated. Sounds like your question implies that there's greater CapEx up front to get to where you need to get to, but maybe the financing markets can help you, right? If I look at sustainability linked finance in other industries, the cost of capital may very well be lower than conventional finance. And so that might be a way to make the math work in the near term. So I'd encourage folks to explore, you know, capital raising ideas around these projects that can benefit from the sustainability footprint.
I think a lot of real estate owners are beginning to, and they're evaluating ways in which, as technology progresses, and they know that retrofitting an asset, say in Manhattan, is going to require a lot, right? They're going to have to invest an enormous amount into something they already own. And what's interesting is that to the extent that that virtuous cycle on the capital side can be facilitated and advanced, it just accelerates the willingness of owners to take risks on more innovative, more out there technologies than I think they would otherwise. And I think that's really exciting because that's what we want real estate owners to do, right? Is to make cost of capital decisions that internalize those externalities and their environmental impact. I'm curious to kind of explore something I know you're interested in around collective action. And I was thinking, as I said, Manhattan. Manhattan sits at the intersection of three different states. There's different political incentives. There's all sorts of authorities that govern how they all, relate to one another. And that collective action issue can kind of pose a dilemma in solving something like climate change. How have you seen that play out? And how do you think we can help overcome that? Because that's so idiosyncratic to location, which is the driver, obviously, of the real estate industry.
Yeah. Well, you mentioned Manhattan. So it's certainly the case that New York City as a whole should plan for a future with meaningful sea level rise and an increase in weather events. No question about it. But to get to your question sort of this way, look at the magnitude of the common challenge New York faces. So it's not alone in what I just described. About half the world's population lives in cities. The majority of those cities are within 60 miles of the coastline. And a significant number of these cities are built basically within 30 feet of sea level, so quite close. Together, these cities in the aggregate are responsible for a very, very large portion of the world's GDP. So the coastal location of many of the world's cities, including New York, gives us sort of a geographic starting point of sort of common interest. Now, I would say that among those cities, given the amount of carbon already in the atmosphere, adaptation is pretty important right now. I mean, we've had our own experience with that in Manhattan, and you'll see other things around the world. To make the magnitude of the challenge even bigger, let me mention this. So in terms of slowing the rate of future emissions, if the world has a hope of limiting global warming to about 1.5 degrees Celsius, so the Paris targets, most observers agree CO2 emissions would need to fall by about 45% between now and the end of the decade. So that's in 10 years. You'd have to get to net zero by 2050. And even if the target is raised to a 2 degrees Celsius scenario, you're talking about emissions falling by a quarter by 2030 and then net zero by 2070. So I raise this because you're asking the question about real estate in Manhattan, but that is a massive issue for cities around the world, people that live in them, people that work in it. So real estate has its part to do, but so do all the other businesses that form that ecosystem and governments as well. So I think that, the one thing I would say, again, if you take a page out of what other industries have done, many of them are making these leaps in a situation where there's a high degree of uncertainty around rate of payoff, magnitude of risk you're mitigating. It's big or it's enormous. It's somewhere between the two. But they're taking the leap anyway. And some of them have benefited from lower cost of capital while doing so. And so the challenge would be in the real estate industry in these geographies that are challenged by climate, what's the answer for that industry leveraging sustainable finance?
Yeah, and I think there's another complexity to real estate, which is, if an industry is impacted by climate change, a lot of industries you can move. To some extent, globalization is an indication of that. But other than capital markets, real estate has not been globalized in the sense that the Empire State Building is still in Manhattan. You can't move a building. And so you would almost think that impresses a certain expediency and urgency on the real estate industry's imperative to solve this and to take swift action and to kind of think more outside the box, more in kind of injecting sustainability into the core, the ethos of what they do. And I guess, do you think there's any industries that the real estate industry in particular can learn from? I think a lot of real estate owners are grappling with this, but where could they look to learn what to do?
So I guess I'd say a couple things. I think clearly location is particularly acute in real estate, no question about it. But there are other industries where physical location, it may be able to be moved, but it's very hard.
Right.
And so physical risk is something that I see allocators of capital focusing on increasingly. So that can be outside of real estate. If you look at the physical interdependencies of, say, a supply chain, or certain facilities or factories or plants that can't be easily moved. That's going into investors' assessment of the viability of the businesses that rely on them, and that will affect whether they invest or what rate of return is required. Physical risk clearly is super important in real estate, and so I see that whole concept coming to the fore. So I think in terms of learning, well, you have to think about building materials, the whole ecosystem around the building. There's a retrofitting issue as it relates to installed stock. Some of that is a relationship between what municipal infrastructure is going to be to help mitigate some of these things and the private sector. And so I think basically every industry is going to have to transform itself to some degree, and there'll be lessons to be learned. I would say that the early adopters of, if you're large enough and capitalized enough to do it, seem to be getting pretty early benefit from the markets for doing it. And so it may be better to try and do these bold things now rather than wait.
Yeah, I think that's totally true. And certainly in the real estate industry, we're seeing that. And to some extent that has been favoring larger, more institutional owners that kind of are thinking with a longer out time horizon, and can then make the corporate and strategic adaptive moves now to reflect on that. And I think it's more challenging for an individual owner who's saying, there's all this new technology out there, there's all this innovation coming. How do I, as a real estate owner, make sense of all that? Because it almost feels like you're asked to do more as a real estate owner today than you ever have been. You both have to provide space, and you have to do all the things that you always had to do in the real estate industry, but you need to make sure that space and that building and that asset is sustainable now and for decades. And that is just not something I think owners ever had to grapple with previously.
So let me ask you a question, Ben. So that's interesting. So that suggests to me that scale is increasingly relevant in real estate. That's certainly true in other businesses, that you see that scale becomes increasingly important because of the magnitude of investment required. You also see that in industries where tech investment is important, right? So as the percentage of tech required to be invested grows as a percentage of revenue, it gives bigger players greater scale advantage. You focus on venture and tech as it relates to real estate. How does that relate to some of the things that we've been talking about?
It's a great question. I'm very happy you asked this question, because it's something I've thought a lot about. When Fifth Wall was formed and we proposed this kind of novel thesis of real estate owners, so owners of assets, should invest capital into technology through a venture capital fund that we managed, it was very far out there. This was in 2016. The questions you'd hear from real estate owners or the responses would be, I don't invest in technology, I'm a real estate owner. And what's so interesting is, almost plotting the growth of Fifth Wall, we went from 7 US real estate owners in 2016 to now 60 across 14 countries, every major sector. So clearly there was this kind of age of enlightenment where real estate owners did what I would almost refer to as a reconceptualization of what they were doing. And the way that intersects with what you're asking about, like the larger, more institutional owners, and is there an advantage to bigger scale? It was all big scale real estate owners that could actually make that investment. And I'm biased, but I believe that those investors have had a huge advantage in seeing technology and what's coming next. And I think the same thing is playing out around sustainability and climate tech, which is the individual owners. It's hard to retrofit a building with new technology when you're trying to run a building, because you have to assess what is coming out of the innovation economy and all this newfangled climate tech that's very hard for you to understand. But what we are seeing, and it's interesting that it's starting with capital markets first, the largest capital markets allocators are saying exactly what you are saying, which is that this is a systemic risk. We need to invest in the technology that mitigates the systemic risk because we're thinking in terms of decades. That's already been happening in climate tech. Now it's going down to kind of the next level down of the super institutional real estate owners that have portfolios across the US, and they are beginning to. And so again, I think it's a big opportunity because you mentioned this example of how the packaging industry came together as an industry. I forget the phrase you used. Co-opetition.
Co-opetition. It's a terrible word, but anyway.
I like that phrase.
Cooperating, co-opetition.
But it's actually it's a great word because it's exactly what goes on today in Fifth Wall. Like we have in the home building sector, we have Lennar, the largest home builder, D.R. Horton, Pulte, and Toll Brothers. That's 4 of the top 5 home builders in the US. In the home building space, they are in competition with one another. When it comes to building more sustainable homes, they are not in competition with each other. And so there's this similar reconceptualization of what it means to be a real estate company, where I think they're going to have to think about themselves as climate tech investors in addition to real estate owners. And that's a wholesale shift. I mean, that is profound if that happens over the next decade, and really inspiring.
And I think you'll see patterns in other industries. So folks can consider that as they embark on this. And I think the degree to which there's going to be a little bit of trial and error, no doubt. So not everything is going to work, but I think the payoffs can be huge because the magnitude of the challenge that we've talked about is epic. You know, one other thing in addition to physical risk that allocators are thinking about is, and I don't think anybody's quite cracked this code, but clearly climate and the shifting patterns around it. So you can think about not just point in time events, disasters, you could just think of aggregate greater number of heat waves, right? You could think of water scarcity and quality being sort of a chronic problem. Agricultural patterns may shift, all of these things. That, you could argue, will have an effect probably on the distribution of economic growth, right? Some people will be favored and some will be hurt, but it might be significantly negative enough on the broad infrastructure of the economy that it actually has the potential to lower trend growth, maybe globally, but certainly in places. So people have started to think about in their broad models where they have long-term capital market assumptions, what kind of return are we getting and so forth, which has a lot to do with an econometric view of earnings growth, GDP growth, and so forth. Climate risk is starting to be thought about as an input into that. And there's a number of academic sort of sources that are working on that. But I think all I'm saying is I think that gives us a sense of the stakes and the magnitude. And so things like competitors collaborating on inputs into their collective business may seem odd, but it's essential because the magnitude is so large that that's the only way it's going to work.
Yeah, and similarly, probably corporations that never did something like invest in, integrate sustainability technology and climate tech is going to become imperative. It's going to become, if you're not doing it, you're on the wrong side of history. I think it's so exciting personally because it feels like this is achievable and there are precedent industries that the real estate industry can learn from. So Hugh, this has been so interesting just to get your thoughts from your obviously really unique vantage point and expertise. So thank you so much for sharing with us.